Unfortunately, Apple just issued a stark warning. And if it's a trend for both them and for other large companies, this is something you and I need to know about. So let's jump in. In today's video, I'm going to share with you what the warning is, why it matters, and most importantly, what you and I should be doing. So what's the warning? Well, the warning came out during their most recent quarterly update to investors. And China's sales were low, but that's not what the warning is, so stick with me. So I'm going to use this article by Zero Hedge. The title of the article is Apple Slides After iPhone Sales Miss, China's Revenues Unexpectedly Tumble. Now remember, that's one issue, but the second issue is the bigger one. Okay, so Tyler Durden, the author, says, the one big fly, very big fly in the ointment was the usual suspect, China, where revenues unexpectedly tumbling, sliding a whopping 11%. But then elsewhere, it's this later sentence that I want to go to. Elsewhere, Apple board of directors declared a cash dividend of 25 cents per share for the company stock. And the author, Tyler, says, translation, no $50 billion stock buyback announcement this quarter. Okay, so that's a big deal. First off, what is a stock buyback? A stock buyback is when a company buys back their stock, and that generally is a good thing for investors because then imagine you had 100 shares of stock and somebody bought back, the company bought back 20% of those. Well, if you had $100 in earnings, instead of those earnings being split amongst 100 shares, they're only split amongst 80 shares. So now, if my math is right, instead of everybody getting $1 each, everybody got $1.25. So it's a big deal, okay? And to show what a big deal it is, Motley Fool did an article, Apple's $725 billion. Now that's a lot of money. That's almost $1 trillion. That's 3/4 of $1 trillion. Apple's $725 billion investment is fueling its growth, and it has nothing to do with Apple Intelligence. Okay, so their key points is they have a key competitive advantage, obviously, because they're Apple and they have a lot of technology. Their biggest investment has had a decisively positive impact on its bottom line results over the last 11 years. So notice it says its biggest investment. And Apple is one of the Wall Street's largest businesses for a reason. It was the first company to break $3 trillion. And it's the second largest company in the United States, second only to NVIDIA, which has had just a meteoric rise. So what is this $725 billion investment that's been so crucial to Apple's growth? It's their ongoing share repurchase program, which serves a number of purposes for Apple. For one, as noted, it reduces the company's outstanding share count, which can increase the earnings per share. That was the example I gave to you. Second, buyback programs tend to incentivize long-term investing. Why is that? Because investors can hold it very tax efficiently. The stock very tax efficiently. When a company buys back stock, it's generally not a taxable event for its investors, but yet it helps increase the value, where if they send out a dividend to investors, which Apple does as well, but dividends for many investors is going to be a taxable event. They're going to be taxed on it. And the third thing is it sends a signal. It sends a signal that Apple thinks that their stock is reasonably valued, attractively valued. How big are these buyback programs? You can see here 2013, it's almost $23 billion for Apple. 2014 was $45 billion. 2015, a little over $35 billion. 2016, $30 billion. 2017, about $33 billion. 2018, $72.7 billion. 2019, $67 billion. 2020, almost $73 billion. 2021, $86 billion. 2022, $89 billion. Stick with me because the numbers get bigger. 2023, $77.5 billion. And in 2024, almost $100 billion. So that's a lot of money. And so what happens if Apple stops buying back some of their stock? And it's not just Apple, it's many of the large companies in the S&P 500. Part of why their stock is going up in value is because the companies keep buying back their stock. It's controversial, right? Because it's taking cash off of their balance sheet that the company could use to weather difficult times. And it's spending it to buy back stock from its investors, which means it no longer has that cash to weather difficult times. We saw some companies get criticized for that during the COVID downturn when they then went and asked the government to kind of bail them out, give them a low-cost loan, something like that. And the critique was, well, gee, if you hadn't done these big buybacks, you would have money. My thing for you and I, why is it important to you and I? Right now, you know what? The stock market, it ain't cheap, right? So how non-cheap is it? How expensive is it? There's two people I like to follow for this for valuation measures. One is Warren Buffett. He has an indicator that he has indicated, general public calls it the Buffett indicator, which is the value of the total U.S. stock market divided by the gross domestic product of that country. And thanks to current valuations, current market valuations, we have this chart that puts it in historical context and gives us standard deviations. And you can see right now we're 2 standard deviations above what that historic norm has been. The other indicator that I like to use is by a professor at Yale University. His name's Robert Shiller. And Shiller uses something that he calls a CAPE ratio. So it's basically a more sophisticated PE ratio. And all a PE ratio is how much are people willing to pay for $1 of earnings from a company. So if a company is trading at a PE of 20, that means investors are willing to pay $20 for every $1 that the company reports in earnings. The problem with that is it's very cyclical. It goes up and down pretty rapidly. So Robert Shiller's insight was, let's use a 10-year rolling average. He calls that the 10-year CAPE ratio, which stands for cyclically adjusted PE ratio. And if you look at Shiller's report, again, thanks to current market valuations for this chart, you can see here that we're, close to 2 standard deviations high on this chart as well. So what does this mean to you and I? What it means to you and I is, we have to be careful. Now, I'm not a believer in timing the market. I think in general, it's time in the market that helps most investors win, not trying to time the market. And there's really 2 factors that help out investors. One is having a long-term strategic allocation. We're not changing it every year. We're saying this is likely what I'm going to be able to stick with for 3, 4, 5 years, maybe longer. And this is my allocation during that time, in good times and bad times. I'm sounding the alarm here because the market over the last 2 years has been very, very strong. In fact, over a 2-year period after the October 2022 lows, the market was up 60%, 60%. Any market, the S&P 500, anything that can go up by 60% in 2 years, I feel, I don't have a crystal ball, but I feel it can also go down by 60% in 2 years. I don't think that's going to happen, but it could. And because of that, you want to look at your long-term allocation and did it maybe get out of whack as investing was fun over the last 2 years and the market did so well. And if you did get outside of your long-term asset allocation, I encourage you to look at that. And it's much easier to go back to your long-term asset allocation, which for many people will mean selling some stocks because stocks have done so well. It's a lot easier to do that when stocks are at all-time highs as opposed to after it's dropped. It's also a lot easier for all of us to enjoy our journey. Remember, we're doing all of this work to be able to retire, and it's easier for us to enjoy our journey if we think of just that, enjoying the journey, not just the destination, which is why I made this video here. 8 things to stop doing in your 60s in order to enjoy your journey until you get to retire. I'll see you in that video. Bye-bye.